An important Burmese proverb says, if you take big paces, you leave big spaces. And Bio-Techne is no exception, having started their growth by acquisition strategy in 2013. This has provided them with a portfolio of products destined for high growth. But high growth comes with a cost.
Good evening, everybody, and thank you to the CFA Society judges and everyone else in attendance. My name is Grant Flegel, and alongside me are Jake Newsom, Tyler Hendrickson, and Tanner Steele, and we are proud to represent the University of Minnesota-Duluth.
We are initiating a hold recommendation on Bio-Techne Corporation with a 12-month price target of $178, representing about 8% downside from current price levels. Valuation is supported by implications of growth through its acquisition strategy, OEM integration issues, and heightened competition, resulting in lower returns and slower than expected growth.
Bio-Techne predominantly operates in the life sciences, tools, and services industry, and also serves the biotechnology industry. Growth within the industry is projected to decelerate in the coming years, attributable to factors of increasing global headwinds, which include increasing competition, industry consolidation, and pharmaceutical pricing legislation, with additional macroeconomic trends of rising interest rates, intellectual property infringement, as well as trade policy concerns.
Entrance of a multitude of small startup companies focused on cutting-edge innovative products garners competition for Bio-Techne's high-growth diagnostics genomics segment. Pairing this with the industry-wide trend of consolidation speeds innovation and product deployment through capital injection. Bio-Techne is limited by this, as they are more restricted in their capital deployment capabilities compared to their larger peers.
Pairing this with the renewed bipartisan agreement by lawmakers to begin a war on drug pricing, the industry is set to see a negative impact on sales, thus reducing the ability for R&D spending that Bio-Techne services. Also, Bio-Techne and its peers are pursuing international expansion, specifically in China. Because of China's 2025 plan, we predict slower growth sourced from this region. The plan includes increased domestic spending on healthcare, which is coupled with trade policy concerns that have materialized in the last year. This being said, you might ask how Bio-Techne is positioned within the industry.
Bio-Techne's industry positioning, realized through our 5 forces analysis, shows that its protein platforms is a strong base business. However, the prospective high-growth business has a high intensity of rivalry, as well as many new entrants, creating an increasingly competitive market. Now let's take a look at what Bio-Techne does.
The company operates through 2 reportable business segments: Protein Sciences, which provides reagents for diagnostic, therapeutic, and life science applications, is the largest and most profitable segment. The Diagnostics and Genomics segment provides products such as calibrations, controls, biological components, as well as instruments.
Protein Sciences and Diagnostics and Genomics generated revenues of $533 million and $110 million respectively, growing 9% organically in fiscal year 18. Further dissecting revenue composition, pharma and biotech account for the majority of revenues, followed by academia, OEM, and distributor relationships. Geographically, the Americas account for over 50% of revenue, followed by the EMEA at roughly 30%, and Asia makes up the remaining 15%. Now to the leadership team.
Since 2013, Charles Cummett has been President and Chief Executive Officer for Bio-Techne. His extensive experience in the industry and M&A suit him well as CEO. On the right is Chief Financial Officer Jim Hipple. He has been with the company since 2014, and prior to joining Bio-Techne, he has served various accounting and finance roles within the industry. Considering the diversified business lines of Bio-Techne, how does it compare to peers within the industry?
The competitive landscape is highly fragmented and ever-changing, and we have identified Thermo Fisher and Bio-Rad to be 2 of the closest competitors. Of the total competition we have identified, Bio-Techne is a leader in its legacy business, proteins and reagents, but it lags many of its competitors with its smaller portfolio of instruments.
Moving into our assigned rating, our hold recommendation is not based on the quality of the company, but rather the current overvaluation by our analysis. Key assumptions include delayed revenue recognition for Bio-Techne's largest acquisitions, ACD and Exosome, OEM timing complications, and increased competition. Consolidation trends in the industry, paired with acquisitions having an extended timeline to integration, we do not foresee meaningful financial improvement until 2020 in diagnostics and genomics. Based on last quarter's financial performance, coupled with management's guidance for no major acquisitions in 2019, we expect this to be a slower year for Bio-Techne, with the possibility of only a few small tuck-in acquisitions. In 2020, however, we expect acquisitions to begin to synergize, resulting in a trough in margins with the possibility of a turnaround headed into the late fiscal year 2020. Adding
to this point, Bio-Techne acquired ACD to bolster OEM production and top-line growth. However, the company has experienced timing issues over the last 2 fiscal years. The acquisition was able to prop up the diagnostic segment, but ultimately the integration is taking longer than expected. We believe that this will take longer with management's focused on genomics, and they will continue to have further synergy recognition difficulty in the OEM division.
As mentioned earlier, the industry is pushing to enter Asian markets. Increasing competition in these regions is placing downward pressure on Bio-Techne's growth prospects, most notably in its high-growth diagnostics and genomics segment. Pairing this with the risk of intellectual property infringement, management has clearly stated that they cannot and will not bring their premium products into these regions, namely China. This will have a material effect on the top-line growth prospects for the company if the current nature of the Chinese markets is not resolved.
These catalysts have impacted Bio-Techne's financials in multiple areas. To analyze Tech's income statement, we conducted a common size analysis, incorporating team projections for 2019 based on our model. From 2014, we can see margins trending downwards with a predicted gross margin value of 65%, which boils down to an operating margin of 24% due to increased integration timelines and associated costs, ultimately resulting in a 16% net margin for 2019.
Examining our thesis and balance sheet in depth, we utilized a DuPont analysis, in which we can see both ROA and ROE trending downward while the equity multiplier is expanding. This confirms our analysis that Bio-Techne is realizing lower returns on their investments. To finance acquisitions, they've resorted to using available cash and increasing their debt leverage, which changes the dynamics of the balance sheet. Furthermore, conducting operating efficiency analysis, we can see that inventory turns and asset turns have been decreasing since 2016, contracting 20 and 5 points respectively to 3.19 times and 0.41 times.
Despite the identified issues on the income statement and the balance sheet, Bio-Techne has focused strength in its cash flows, having grown operating cash flows at a 5-year CAGR of 4.5% to $170 million, and free cash flow growing at a 5-year CAGR of 4%, reaching $149 million. Now on to our valuation.
To value Bio-Techne, we performed an intrinsic valuation through the construction of a discounted cash flow model. We applied short-term sales growth of 12.5%, long-term sales growth of 7.7%, and terminal sales growth of 3%, as well as a WACC of 8.7%, among other assumptions. When we apply these assumptions to our model's free cash flow projections, we arrived at an intrinsic value of $178 per share.
To support the accuracy of our DCF, we examined the average trailing and forward PE and PEG ratios. After a closer look, it appeared that the current PE levels appear to be inflated at levels of 74 times trailing and 37 times forward, compared to respective averages of 43 times and 28 times. Pairing this with the PEG ratio of 3.6 indicates to us that the price is currently ahead of itself compared to its key industry peers, Thermo Fisher and Bio-Rad, who hold respective PEG values of 1.8 and 1.1, with the industry average of about 1.7.
Conducting an EV to EBITDA valuation helps further solidify our thesis. We used a 29 times forward multiple and an estimated 2019 EBITDA of $250 million to arrive at a price target of $181 per share, not including net debt. But what are some key risks to our investment recommendation?
Key risks we have identified are Bio-Techne's growth by acquisition strategy, which could potentially result in a high value of goodwill at the risk of dilution or impairment. Second, if Bio-Techne is unable to remain competitive within the industry, they may see a loss of market share. And third, the US and other countries are fighting the theft of intellectual property in China, which poses additional risk to Bio-Techne's international operations. And lastly, the increasingly tight labor market may force Bio-Techne to pay higher compensation packages to its employees.
Delayed synergies from acquisitions, timing issues in the OEM division, and increased competition in a consolidated market provides evidence to support our recommendation. We would like to reiterate our hold on Bio-Techne with a price target of $178, representing about 8% downside. Thank you. We'd like to now open the floor to questions.
Lindsay Strickland with RBC Wealth Management. So my first question is that when I'm doing the analysis, I try to always read the proxy statement to see what metrics the management team is bonused by, whether it's revenue or EBITDA. Do you know those metrics for this company?
Yeah, so I'd love to answer that. Short-term metrics that they use for bonuses is adjusted operating income growth and organic revenue growth.
at a certain level, or do you know if they set a bogey for that, or if it's just reaching a target, you find out later?
It's determined year to year if they reach those goals. I don't have an exact level for you, but those are the two metrics, and they will discuss it at their annual meeting and determine it from there.
Thank you. And then my other question is just simply on how they get paid. So do they, sell products one by one? Do they sell consumables on top of instruments? Is it on a subscription basis at all? Can you talk a little bit about the revenue recognition?
So a lot of their revenue recognition is repeated business due to the clinical diagnostics and tools that they use. So they'll sell a machine, and then those proteins are the gold standard in the industry. And so those proteins will be used in the instrument that they have provided in the past.
Julie Gray with Columbia Threadneedle. I'm curious, I understand that they're growing quite a bit in China. I'm curious how they're getting that growth and what you see as the future impact of tariffs.
So they've grown through acquisition by that. They have a headquarters called Biotechne Hong Kong, in which is their Asia market. Can you repeat the second part of that question?
Yeah, how you see the effect of tariffs playing out for this company?
Yep. So it does not directly affect the company, but what we do see issues with is the possibility of supply chain clogs happening, which would in turn affect the outcome of the final sale of the product.
And around Nuveen Asset Management. Can you guys just provide a little bit more detail on what exactly is their competitive advantage in the marketplace? You've talked about a lot of competition coming in, so what exactly is their competitive advantage? And what is it that the value that they provide to their customers?
So as we stated earlier, they are the gold standard in their proteins and reagents. So they have a lot of customers that come to them for that because they are the best in the business for that. And the value, you say the value it provides customers?
Yeah.
So with that, they know what they're getting. They know what they can expect. They know it's solid proteins reagents, that results will be positive and will remain the quality is high, and they know the results will be meaningful, and there's not a large chance of errors from those reagents.
And if I could add to that, they're working to move into GMP proteins and reagents, which is basically the best you can get for these reagents. So they're providing extra value to their customers by supplying these reagents to them early in the process, so they don't have to spend a lot of money on switching later on.
Scott Upsall, Luthold. Over the last few years, you noted that margins have been coming down as they've been making acquisitions. How much of that do you think might be temporary issues like integration and reorganization that would reverse out, and how much might be a permanent reset of the business to a lower profit level?
So we believe that it is a short-term problem because the acquisitions, they do not fully integrate right when it happens. So the integration will eventually happen, in which we stated earlier in 2020, we expect the synergies to begin to happen, which margins will then begin to trough with the possibility of a turnaround, which we expect margin improvement by 2021.
Clem Mao from Winslow Capital. So you had a very thorough analysis on competitors, but it seems most of them are US-based companies. So just wonder if a company called Abcam in the UK, if that is a direct competitor for Biotechne, and if yes, what are the strengths and weaknesses of Biotechne over Abcam?
It is a direct competitor. They are positioned in Europe they have a very solid position in Europe with their Biotechne, I believe it's United Kingdom, or one of their headquarters over there. The issues that we see right now in the United Kingdom is the Brexit vote, and that has taken a toll on both the pharmaceutical and biotechnology segments of the industry. And so that's where Biotechne being located in the US and having a presence in Asia can offset those risks.
And then the second question, looks like consensus is expecting around 15% free cash flow margin for the current fiscal year, and that is quite a bit lower than the 20 to 30% in the past 3 to 5 years. So do you expect that to be a temporary thing, or do you think it is more structural?
We do believe it's going to be temporary. As we said, the integration of ACD and Exosome, those were two very large deals in which have not fully integrated with the company yet. And so as those begin to integrate, operating margins will improve, and as correlated will free cash flows.
So they are waiting approval on this exosome product, and I understand that could be a big deal if they get it right. So how have you factored into that? How have you factored that into your analysis, and how do you see that playing out for the company?
Oh yeah, so management had stated that they aren't going to see reimbursement within the first half of this year. So we don't really play that into our model until 2020, when that's more of a certain thing.
To add to that, in the last quarter, management talked about their accounting for the reimbursement of the EPI test, which is the one that is awaiting approval, and they did not receive enough information to begin accrual accounting to recognize those revenues. So we believe that will continue to delay a little bit, as we said, hopefully early 2020, if not late 2020.
Do you know how much they've been paying for their acquisitions as a multiple of EBITDA or whatever the most relevant metric is? And do you think that they've done a good job with acquisitions, or have they made mistakes?
Well, I'm not 100% sure on the multiple. The industry as a whole is a little overvalued right now. Prices are ramped up, so they definitely paid a premium. And we do think they are solid acquisitions. It's just a matter of getting those gap filling strategies to integrate with the company, bringing down the costs of those. So let me back up quick. The three main things that management wants is a gap filling strategy, synergies from bringing it all in-house, and increasing the capability of those products and developing and continuing to develop those. So as those are delayed, yeah, we do think they're beneficial.
I'll just do a follow-on to that question. So it doesn't sound like you guys actually went through an analysis in terms of, even if you took a sample, they've done a lot of acquisitions, do some kind of sample analysis on the multiples that they paid, and or looking at, are these actually accretive deals? Because the history of M&A, broadly speaking, is really bad. So generally, it's destroying shareholder value rather than creating. And so I'm just curious if you guys spent any time looking more deeply, even if it was at a sample, at M&A.
I think that we could use ACD as an example. Management stated in their last quarterly results that it impacted operating margins in the diagnostic segment by about -2%. And I think that the timeline on that will eventually see accretion.
So we have time for one more question.
With your hold recommendation, what would you say is the single strongest talking point that would support a buy and the single strongest for a sell?
Yeah, the management team is very strong. We really like their background and what they've brought to the company ever since coming on, which is really good for the buys. We like the gap filling strategy and the idea of the acquisitions to fulfill the portfolio of products that they are looking for. The sell, it would be valuation. We're very concerned with how overvalued it is, even in an industry that is overvalued itself.
Yeah, I think that's it. We just have 20 seconds left. So.